right, good afternoon, everyone. Welcome. I'm in a room today, obviously in New York State, practicing social distancing, so I have a great panelist to help us get through tax implications of the CARES Act. We always like to put the date out there because we all know that a lot of things are changing and they change quickly. We're confident with the law that we have in this packet. We're not so confident of how the IRS is going to be able to get these benefits into our tax forms from a compliance perspective, but we are going to share with you the tax law changes and then obviously continue our communication throughout the next weeks and months regarding this act. This is part of the major CARES Act, and we know that the CARES Act was passed on Friday last week. We also know, and we'll have a brief update regarding the loan piece of the CARES Act, but again, it's a major stimulus bill to try to put money back in people's pockets, both businesses and individuals, to help us during this pandemic period and help us during this time in our nation. So the first thing we want to point out to you is you all will be on mute. We are asking you to write your questions in. If you have questions, write them to all panelists. Essentially what we're going to do after this webinar is we're going to get together and look at the most frequently asked questions and try to answer those questions if we have answers for you at that time and give you guidance with those questions as we move forward. The presenters today include myself, Lynn Musensky-Keck. I sit here as a Rochester partner in the Bonadio Group. We also have Rob Zielinski with us today, who also is a partner in the Bonadio Group, and Eileen Stemler, who is also a partner in the Bonadio Group. Eileen is one of our prominent small business advisory partners and helps us a lot through our estate and gift tax as well. So the agenda today, we're going to first just do a brief introduction, then we're going to move into a business update, and then we're going to wrap up with an individual update. All the items listed on the slide there include items that we hope to discuss and get to within our time allotted today. I do want to take a brief time period to give you a CARES loan update. I think it's really important that we're disseminating this information as quickly as we can. So you are aware, if you've joined us before or are enrolled in our Client Insights, we did do a webinar, a closed webinar, no outside, just internally last night, and really updated you based on where we know we are today. That will be being disseminated to everyone either now or within the next 2 hours. 2 to 3 hours, so you should be receiving that. But within that webinar, we wanted to highlight some of the significant items that we clarified and were able to receive clarification on. The first being based on the advisory we were given by Senator Chuck Schumer's office and a variety of other outlets. It is indeed, you are able to apply for both the CARES PPP loan, which is the Paycheck Protection Program, and you also are able to apply to the Small Business Administration, what we refer to as EIDL loan, Economic Injury Disaster Loan. There was some concern that maybe you could only apply for one or the other. It is all hands on deck. You can apply for both. You can receive funds for both. The only item that you have to be careful of is that you use your CARES funds within the first 8 weeks after the loan origination date on those specific items in order to get debt forgiveness. In addition, at 10 o'clock on Sunday evening, SBA EIDL put out this new website. The application process is extremely different, much shorter, okay? And essentially what they're looking for are your past 12 months of gross receipts and your past 12 months of cost of goods sold as of, I believe it's January 31st. And so it's really important that you utilize this website. It will be a quicker time period in which you can get your EIDL loan. In addition, based on the CARES Act, the EIDL loan application also will have you certify that you are a business who can receive the EIDL loan, and by certifying to receive the auto loan, you will automatically receive $10,000 within 3 days of the loan application date. What that means is even if later you get denied the auto loan, you still get the $10,000. They're referring to it as a grant. It will not have to be repaid. Okay, so right now we are advising all clients it makes sense, go after your CARES PPP and your EIDL loans together. The last thing I want to point out is the CARES mid-size loan relief. We did also see that in the CARES bill, and essentially that's going to be out there for larger corporations or businesses, including non-for-profits. My non-for-profit friends who are on the phone, if you have employees between 500 and 10,000, they're going to be issuing loans with not an interest rate greater than 2%, and essentially will allow for you to defer the principal and interest for the first 6 months. I know we've been receiving a lot of questions from employers between 500 and 10,000. We hear you. You're going to hear about some more potential advantage with payroll today from Rob Zielinski. But essentially, we really wanted to provide you with all this information. 1 second. I do also want to talk to you or inform you that it was just released. I'm sorry, my computer shut down. I should have looked at that. That there is, it was just released if you are someone who's involved in Medicare payments. It looks like you can request in advance for your Medicare payments for the next 3 months. With some specific information that's out there. So we wanted to give all that information to you. The last thing I'm going to put in here, because I know we have a lot of people who are dealing with this who are also interested in the tax update, is that if you did apply for the SBA EIDL loan before this new process went into place where you got the $10,000 grant within 3 days of your loan application, if you applied before that, you need to reapply. Okay, so we're giving you that direction now. Now we're going to shift gears a little bit, and we really want to focus in on what's going on from a tax world in this CARES Act. The first thing I want to point out to you, I know this maybe seems like old news, it was last week. There was actually 2 notices that went out last week, Notice 2020-17, and then it was superseded by 2020-18. And essentially what the notices are telling you is if you had a tax return that was due on April 15th, it is no longer, federal tax return, let's be clear, it is no longer due on April 15th, it has been delayed until July 15th. And not only is it your requirement to file your tax return, which was originally in the original notice, but it's also the requirement to pay the tax liabilities due. So essentially for an individual person who was looking to file on April 15th, they don't have to pay their 2019 remaining tax liability or their first quarter estimated tax payments until July 15th. And there's no paper that you need to file in order to get that. The extension are for individuals, trusts, estates, partnerships, associations, companies or corporations who had a due date as of April 15th. It is now moved to July 15th. We get this question a lot. What about our second quarter, our third quarter, our fourth quarter payments? Those are still scheduled as is. The other piece I would like to point out is there still seems to be a lot of confusion on reporting. Notice the first notice that came out put a max limit and said you can only defer $1 million in taxes if you're individuals or $10 million in taxes if you're corporations. That limit of your ability to defer tax payments that were due April 15th was lifted with the Notice 2020-18. So it's important that that is properly communicated. So for example, if I'm an individual and I owe $750,000 related to my 2019 tax return, and I also owe $500,000 related to my first quarter 2020 estimated tax payment, that exceeds $1 million, and I am able to defer that total $750 plus $500. We'd also like to point out a lot of us were nervous at that time because we said, well, what about our federal gift tax returns or generation skipping transfer tax payments? They came out with Notice 2020-20, which said we will also be delaying those from April 15th to July 15th, 2020. So essentially, these were all somewhat relieving provisions to allow us to, A, keep more money in our pockets to run our businesses, but B, also because of just where we are today and the limited ability to transfer information, it has helped us with our filing deadlines. It is important to note no extension has been provided for information returns. That includes, as you see here, payroll taxes, but we were recently having the debate of whether Form 5472s, which are sometimes filed for foreign-controlled corporations, would be considered an information return. It technically is. So as a safety precaution, we would advise at this point that you're filing an extension just to cover yourself if that's not being filed by April 15th. The other thing that I'd like to point out, and we've gotten a lot of questions from our not-for-profits, the Form 990 is an informational return. It's generally due on May 15th, and it is not included in this extension, okay? So you are still looking to be required to file that on time. However, if you file a Form 990-T, again, a Form 990-T, that does seem to be under this provision that would be extended. We are so thankful. And trust me, we understand that Governor Cuomo has enough on his plate right now, but we are very thankful for the notice that we were able to get on Sunday that officially has said for New York State, our deadline has been extended from April 15th to July 15th. That was issued on Sunday afternoon, early evening. And essentially, what that means is if you're an individual, a fiduciary, which includes estates and trusts, or corporations, and your tax return and your tax payments were normally due on April 15th, they have been extended to July 15th. Again, for both of these, when we say they've been extended to July 15th, no physical paper has to be filed until July 15th if you want a later extension. The other item that we like to highlight that some people did maybe miss is they also allowed for a 60-day extension for your sales and use taxes that were due on March 20th. Again, to give you a little bit more time to keep that cash in your bank account to allow things to be helping you through this time period. I think some people may not have seen that they did indeed ask you to request relief by applying for it, and we provided you with the website. And essentially, it's just listing your business name, your EIN, and one other piece of information. But it's a real quick application process. So without any further ado, that was really where are we on federal and New York State filing timelines. I understand there's a lot of people on the call that aren't from New York State. Please make sure you're monitoring your Department of Revenue. I think last night I must have gotten 50 alerts from a variety of different states that were delaying things. Ones that jump out to me, I guess I'm going to take a step back and not list them out right now, but it is really important if you're in a different state to monitor that. There is a lot of movement going on in that area. So now we're going to flip over to what did the CARES Act say regarding businesses and how our tax filings going to change based on this update. Here you are going to see us talk about something called the TCJA, and some of you might be aware, some of you might not. The TCJA was a major tax reform bill that was signed in December of 17 that affected our 2018 and 2019 tax returns. It was our first major legislative tax change since 1986, I believe. And so it was a huge movement for us and for the community, right, as a whole. And so the first thing that many people got upset with in the CARES Act was qualified improvement property by error. It was actually footnoted on the side of the bill, written in, but it never made the actual bill. By error was provided the definition of 39-year property. Okay, so let's take a step back and say, what is qualified improvement property? Qualified improvement property is any improvement made by the taxpayer to an interior portion of their commercial building, their non-residential real property building, if the improvement was placed into service after the date the building was first put into place. Okay? So essentially, did you, the taxpayer, make an improvement on the interior portion of your commercial building after the commercial building was put into place. And why was it such a disaster when they said, oh, it's a 39-year life, is because we couldn't get bonus depreciation on our qualified improvement property. And a lot of retail businesses have this qualified improvement property, and so they were stuck taking these improvements and dividing them by 39 years, essentially, and taking a deduction over 39 years, a very slow, no-go process. And so everybody agreed it was an error in the TCJA Act. Everybody said, fix it. We couldn't get partisan support. There was some fighting, some infighting, but something of great importance for us that came out of this that we're currently going through is they finally fixed it under the CARES Act. And so not only did they fix it for the 2020 tax year, but they actually said if you had qualified improvement property for taxable years beginning after December 31st, 2017, we are going to say that it's a 15 years makers or regular class life. And now that opens you up to be eligible to look at those qualified improvement properties that you put into place in 18 and that you put into place in 19 and be able to take bonus depreciation. So be able to immediately deduct the full cost and allow it to impact the bottom line of your taxable income. In addition, we would say to you that in order to take advantage of this technical correction of the qualified improvement property, you generally must have had the improvement in construction started after September 27, 2017. And the other big thing that we point out that we know we've been real vocal with our clients about, and ignore this if you don't even know what I'm talking about because it's very specific, but if you made a real estate trader business election to avoid your interest expense being limited, I'm going to say it again, if you made a real estate trader business election to avoid your interest expense being limited under what we refer to as 163J, you won't be able to take advantage of the bonus depreciation on your QIP. It would still allow you to bring your QIP into a 20-year ADS life, but it will not allow you to take bonus. And that's a more detailed discussion. For those of you who made that election, I think you were aware, that irrevocable election I should provide you, I think you were aware of that or advised of that issue. The other issue I'd like to bring up is we're very excited, right? So now if I had property, a QIP, qualified improvement property I put in 2018 or 2019, I'm jumping off the ceiling saying I want to take my deduction now. I don't have to spread it over 39 years. It's going to drop. It's going to give me a huge deduction. You're right. For my friends who are partnerships, and this is very important, if you, they made a rule that essentially for the partnerships, if you file under the BBA audit regime, it's going to be more difficult for you to absorb that deduction currently. A lot of you out there are partnerships. You're not going to be part of the BBA audit regime. You might have elected out of it. Hopefully you did. But if you didn't, when you make the adjustment, if you're under the BBA audit regime, what we're finding right now is that essentially any adjustment is going to be included as an adjustment on your 2020 tax return. So you would have to wait all the way to 2020 to take the benefit for QIP. Again, only if you're a partnership that falls under the BBA audit regime. Contact your advisor to find out more about what that means. The next big modification, in my opinion, huge modification, has to do with the 163J you might hear people talk about, or the interest expense limitation. Many of you are aware that corporate taxes dropped significantly recently. They were generally at 35%, and they went down to 21%. That was a huge revenue driver of driving revenue down for the corporate government. So the government said, well, we have to somehow raise revenues, and one of the biggest ways they raised revenues was saying you're only going to get a deduction for your interest expense up to a certain amount, okay? And this was not just for corporations, this was for partnerships, this was for individuals, this was across the board. You're allowed to deduct your business interest expense, but only up to a certain amount. So the TCJA essentially said, look at your total business interest expense. You're allowed to take it up to your business interest income, and then to the extent it doesn't exceed 30% of your adjusted taxable income. We're not going to get into too much about what your adjusted taxable income is, but just know it's not your taxable income. It's generally your taxable income plus your depreciation being added back in a most simplistic example. Now, under the CARES Act, they realized, right, that made a lot of interest expense not deductible for businesses across the U.S. That was their intention, right? So that more income would drop to the bottom line, they tax it, and they'd have a revenue stream. However, during this crisis, they realized that we need to push more money back into our business environment. And so now they said, we are going to allow you to take business interest expense up to the amount of business interest income you have that doesn't exceed 50% of your adjusted taxable income. So they raised it from 30% to 50%. And what's even more amazing is that they're going to allow this 50% limit to apply not only to the 2020 taxable year, but they're going to allow you to apply it to the 2019 taxable year, okay? In addition, the other thing I would like to point out is some of us might be forecasting that our taxable income might not be so high in 2020, right? We actually had a better year in 2019, and that taxable income is what we're using to multiply, right, times the 50%. So we're worried that 2020 might be really bad for us. They essentially added into the law that if you get a better solution in the 2020 taxable year by using your 2019 taxable income or adjusted taxable income, you can do that. That's an amazing benefit. So they're essentially going to allow us all the business interest expense in 2020 that we would have been allowed or that we are allowed in 2019. Here's just a real simple example for you so you kind of understand, because I know sometimes when we throw words at you, it can be challenging to interpret them. But let's assume that we had our preliminary taxable income was $500,000. Okay? Within that taxable income number included $500,000 of interest expense and also included depreciation of $300,000. To get to our adjusted taxable income number that we're going to multiply by that 30% or 50%, we're actually going to add back the interest expense to our taxable income, and we're going to add back the depreciation. So under the TCJA rule in this example, I would have only been allowed $1.3 million times 30%, or what we would refer to as $390,000 of interest expense. That means I was limited by $120,000. That means I did not receive a deduction on my tax return for $120,000. Now, under the CARES Act, if this happened in 2019, taking the same exact scenario, I can actually take the full interest expense because now I'm multiplying 50% times my adjusted taxable income of 1.3 instead of 30. Okay, so what does that mean? That means now when I'm filing my 2019 tax return or potentially amending it, I'm going to be able to get a $120,000 deduction. Okay, multiply that by your tax rate, and that's going to be your cash impact. I would point out, again, partnerships, it's a little trickier, okay? I actually think it's good. I think they anticipated that there's going to be a lot of problems with amending partnership returns because of the new BBA audit regime that was put into play. And so instead of saying to the partnerships, who probably most likely, at least 50% of our partnerships across the country filed by March 15th before this really blew up, they said instead of making you go back and amend those returns, we're going to do something different for you. Okay, so for partnerships who did not get to utilize all their interest expense in 2019, which you might already know what that amount is because you got a K-1 that reported that information to you, they essentially are going to tell you you can look at whatever you weren't allowed and automatically get to deduct 50% of whatever you weren't allowed for the 2019 taxable year. You can deduct it in the 2020 taxable year. It does not fall on deaf ears that does not help you now because you can't file your 2020 tax return until 2021. I understand that. But that is the decision that the CARES Act provided for partnerships. The biggest piece of this, just to keep in back of your mind as we go through the business rules, is that this modification is most likely, if you were limited by interest expense in 19, or 2020. It's going to drop more deductions to the bottom line to your taxable income and might even put you into a taxable loss. Okay? And why do we like that? Is because we're going to learn in a little bit that that taxable loss now can be carried back to offset taxes you might have paid in the previous year. And we'll get to that in a second. The other big thing that we want to point out is for corporations. They did put some clauses in here to try to support people giving to charity. Eileen's going to talk about one that impacts individuals, but we're very excited for corporations. They're increasing the amount that you can give to charity. Before, essentially, it said you could give up to 10% of your taxable income under the CARES Act only for 2020. Only for the tax year 2020, just to make clear. They're going to bump your ability to give to charity up to 25% of your taxable income. It's also important to know what is considered a qualified contribution up to get under that 25% limit. They're looking for cash. They want you to contribute cash to a charity. They generally, 170B1A is often referred to as a public charity. So they want you to have a cash made to a public charity. And they're very clear that it cannot include contributions by a donor to a private foundation, and it also can't be for the establishment of a new or existing donor-advised fund. But still, again, trying to promote the ability for people to give to public charities, corporations specifically in this example. This is where the heart, the bread and the butter comes in as to how we're going to put cash infusion in through the tax law. Essentially, you can read through the slides, but I'm going to try to keep it as simple as possible. If in the 2018 taxable year or the 2019 taxable year, you generated what we call a net operating loss, okay, a taxable loss, which means we added up all your income, we added up all your deductions, and your deductions exceeded your income. Under the old law, which is the TCJA, they essentially said if you created a net operating loss in 2018 or 2019, you could not carry it back, which was kind of strange because we've always been used to that. And the previous law, we used to be able to carry it back 2 years. But under the TCJA rule, they said you can't carry it back anymore. You got to carry it forward. It can only go forward. And when you carry those losses that you created in the 18 or 19 taxable year, it can only go forward to offset 80% of your taxable income. So what does that mean? They're always, in general, they're always going to get to 20% of your taxable income to tax and make you pay tax on. Under the CARES Act, they really modified this, and this is probably, in my opinion, one of the biggest pieces of this act. They essentially said, if you create one of those net operating losses in 2018 and 2019 and 2020, essentially, they're now allowing you to carry it back for 5 years. Not the 2 that we previously saw, but for 5. So in 2018, if you created a net operating loss, you couldn't carry it back under the old rules. Now, go back to your 18 tax return, evaluate, right, if you have QIP, evaluate whether your interest expense limitation is going to change, and then calculate your NOL and see if you have one. If you have one, now you can carry it back to all the way to 2013 to get that immediate cash back. In addition, they've also said that you can carry, if you can't carry it back and all you can do is carry it forward, you can carry it forward up to offset 100% of your taxable income. I'm not going to get into too much. There was a technical correction. If you're a fiscal year filer, essentially there was confusion about what if my taxable year began in 2017 and ended in 2018. Under the old rules, could I carry my NOL back? They essentially went in there and said, now under a technical correction, absolutely, you could. So you're going to see a lot of fiscal year filers go after this quickly to help them carry back their NOLs during that time period. There also are special provisions related to the NOL, related to REITs and life insurance companies, related to the fact that you're involved and you had transition tax that you're paying. And so essentially you should be aware that there are special provisions for those items. So essentially, what do I do now, right? Now I'm sitting here with a tax return. There's changes. What do I do? We're going to tell you, go evaluate your 2018 and your 2019 taxable year and see if you have any qualified improvement property that essentially could drop to the bottom line. We're going to go back and tell you to evaluate your interest expense limitation rules for 2019 and 2020 and see if there's potential that more interest expense can drop to the bottom line and help you create losses. And then we're going to tell you to take those losses that you're looking at and essentially carry them back. Again, if you have a loss in 2018, you can go all the way back to 2013 to utilize that loss and get assuming you pay taxes in 2013, and get the IRS to cut you a check. One of the most significant things about the NOL carryback I want to make sure you're all aware of, whether it be a flow-through or whether it be a corporation, most likely if you're going to carry it back 5 years, your tax rate's higher, right? So in general, we would say the corporate tax rate 5 years ago was 35%. So if I have a net operating loss currently in 2019 or that I can carry back against a tax rate of 35%, that's much more advantageous of me than holding it and carrying it forward to offset a tax rate that's currently 21% for corporations. Similarly, you might take advantage of that as an individual. If you carry back your losses, you could have the advantage to offset. The individual tax rate used to be at 39.6, and now it's down to 37%. So essentially, there's great news in this. I know a lot of you are probably saying, how do I carry back my NOL? They gave guidance for that technical correction for those fiscal year filers. They haven't given us guidance yet from the IRS for our calendar year taxpayers who want to start looking at losses in 18 that might be able to be carried back to 13. As we get those guidance and forms, we will obviously be disseminating that information as quickly as possible. Now I'm going to pass it over to Rob Zielinski, who's going to talk about, there's also some potential refund capabilities with your AMT tax credits and significant changes made to deferring your payroll taxes or even taking a credit against them.
Okay, thanks, Lynn. Okay, now we're going to talk about the changes to the alternative minimum tax credits for corporations. Just to recap, when the Tax Cuts and Jobs Act was passed, the corporate AMT was repealed for tax years beginning after December 31st in 2017. And for those taxpayers that were left sitting with a AMT credit, the TCJA provided some very specific rules about how you go about getting that, monetizing that credit. And essentially what you would do beginning in 2018 is you would use as much of the credit as you had available to reduce your regular tax down to the lowest allowable limit, and then anything that was left over, you would get a refund of 50% of it, and then the remaining 50% would carry forward, and you would do the same thing for 19, 20, and then by the time you got to 21, if you had anything left, you would get a 100% refund at that point. Two changes with the CARES Act. First off, essentially, you're able to get the 100% of the remaining AMT credit after you apply it against your 2019 tax. You can claim that in full as a refund beginning for the 2019 tax year. So that essentially took 2 years off of the realization period, if you will, for that. Alternatively, you can actually file a carryback, which we'll talk about in a minute. There was a new provision that was passed that essentially allows you to go back to 2018, and if you have any remaining AMT credit after you applied it against your regular tax, you can claim 100% of that remaining AMT tax in 2018. So that comes about because of a new provision that was added under Section 53E5, and the guidance right now is that if you wish to take advantage of that provision, you would file an application for tentative refund. The exact form of that is yet to be determined, but I would suspect that it would be similar to what corporate taxpayers may have been familiar with in the past with the old Form 1139. Of course, the good thing about a tentative refund is that the IRS does act on it within 45 days. They can always come off and audit it later, but they generally will act on it within 45 days, so the taxpayers will get their money much quicker than they would if they had amended by filing an 1120X. And the time frame for taking advantage of this provision is the filing has to be done by December 31st of 2020. Okay, next we're going to talk about a couple of payroll tax matters. The first is the employee retention credit. Kind of set this up to follow the text of the law, so there's unfortunately definitions upon definitions, but just we'll go through it in great detail, so hopefully you'll have a good understanding. So what is it? So it's a credit against the applicable employment taxes for each calendar quarter of 50% of qualified wages paid by an eligible employer to an employee for such quarter, up to a maximum of $10,000 per employee. Okay, it applies to wages paid after March 12th and before January 1st of 2021. It's limited to the employment taxes paid to all employees during the quarter, taking into account any other applicable credits, including those that were made available under Section 7001 and 7003 of the Families First Coronavirus Response Act. You might remember those were the credits that were passed with earlier legislation to give employers credits for emergency leave and sick leave. The excess credit is refundable. It sounds as though Treasury may prescribe guidance to allow for advanced payment of the credit, and the law also states that if employers fail to deposit employment taxes in anticipation that they'll qualify for the credit, that the failure to make the deposit is not grounds for a penalty under 6656. Okay, so what are the applicable taxes? So it's the taxes that are imposed on the employer. So your OASDI taxes, or if you're in the railroad industry, it's the Tier 1 retirement taxes. Okay, who's an eligible employer? Bit of a mouthful here, but so a couple things you have to work through. First off, you have to have been carrying on a trade or business during calendar year 2020, okay? And you have to meet either one of the following two situations. The first one is that the operation of the trade or business was fully or partially suspended due to government guidance regarding the coronavirus, or there's a mechanical test for a significant decline in gross receipts. So the period for that begins with the first calendar quarter beginning after 12/31/19, in which gross receipts for the calendar quarter are less than 50% of gross receipts for the same quarter in the prior year. So just to give an example. So if your gross receipts from 1/1/20 to 3/31/20 are less than 50% of what they were for 1/1/19 to 3/31/19, then you would qualify if you otherwise meet the requirements. The period in question ends when following the first quarter for which the gross receipts are 80% of the gross receipts for the same calendar quarter in the prior year. So the idea being that if you kind of have experienced a loss of gross receipts and you're starting to kind of come out of it, so to speak, that's the period when the eligibility ends. One thing I did want to mention, the definition of gross receipts under Section 448C may be familiar for those of you who are small businesses that might have adopted the cash method of accounting under the Tax Cuts and Jobs Act. One thing to mention there is that the same aggregation rules that applied for those rules apply here. So when you're measuring your gross receipts year over year for purposes of this mechanical test, you have to take the aggregation rules into apply. or into account rather. For our non-for-profit friends out there, they are also eligible for this without regard to the significant decline in gross receipts test. In other words, if they were carrying on, their organizational mission and they had their operations suspended by the coronavirus, then they would otherwise qualify. Okay, so what are qualified wages? Well, the answer is it depends on the average number of full-time employees. Okay, so you can see if it's greater than 100, then the wages are essentially limited to the amount of wages that are paid to the employees for the period of time that their services to the company, if you will, are suspended as a result of the circumstances, or are due to the reduced gross receipts period. But it's limited to the wages that they would have been paid for the 30 days prior to the start of that period. Okay, if the eligible employers with average number of full-time employees of 100 or less, it would be all wages paid to employees during the period. Again, you have to look at the aggregation rules to determine employer size. Wages taken into account under Section 7001 and 7003 for those two credits I mentioned earlier are not qualified wages. Qualified wages do also include allocable share of qualified health care expenses to the extent they're excludable from income under Section 106. Okay? All right, the fine print. So this is kind of a catch-all of different provisions to be aware of. The rules related to 51I1 and 280C, Cap A, and listed the specific implications of those. Those would apply to this credit. Credit does not apply to federal, state, or local government employers. Employees who are taken into account for the Work Opportunity Tax Credit are not taken into account for purposes of this credit. Similarly, wages taken into account under Section 45S for the employer credit for paid medical leave are not taken into account. If an eligible employer receives a covered loan, which is essentially the Paycheck Protection Loan under Section 1106 of the Act, or correction, 1102 of the Act, which, again, there's been a lot of discussion about that. But if you take advantage of that program, you're not eligible for this credit. And for those employers out there that use a certified PEO to pay their employees, similar to many other employment-related credits, the customer, if you will, rather than the CPEO, is the entity that's eligible for the credit. Okay? Okay, next we're going to talk about the delay of payment of payroll taxes. So this applies to both businesses and self-employed individuals. Okay? So for businesses, there's a deferral of the applicable employment taxes, again, more definitions we'll get into, for the payroll tax deferral period until the applicable date. And for our self-employed persons, the SECA tax under Section 1401A, 50% rather, of that tax is also eligible to be deferred until the applicable date. Furthermore, if you're a self-employed individual, you do not have to consider 50% of your self-employment taxes under 1401A in figuring out your estimated tax payments for the year. Okay. So what are the applicable employment taxes? Again, these are for businesses because we already defined for self-employment or self-employed individuals that it's the taxes under 1401A. But for the employers, it's the taxes imposed under Section 3111A, similar to for the employee retention credit. And then also both the employer and employee representative shares of the Tier 1 railroad retirement taxes. Okay. Okay, the deferral period is on the date of begins on the date of enactment of the CARES Act, which was this past Friday, and ending before January 1 of 2021. So essentially, from the 27th of March through through December 31 of this year. And then what is the applicable date? So December 31st of 2021 with respect to 50% of the amounts delayed, and then December 31, 2022 for the remainder. So to be clear, what we're saying is that the payroll taxes that would otherwise be due during the period prescribed, rather than have to pay them along between now and the end of the year, you can, as an employer, keep that money and deposit half of what would have been due by 12/31/21, and then the other 50% by 12/31/22. So it gives you essentially a deferral, of a little over, 2 years in some cases. Okay, more fine print. Who's not eligible? So any taxpayer who had indebtedness forgiven under CARES Act Section 1106, and again, so this is the one of the hot topics we've talked about, that businesses that apply for the Paycheck Protection loans under Section 1102 and qualify for forgiveness under Section 1106, those parties are not eligible for this deferral. There's also some deferral that's available under Section 1109, and that section really goes into the expansion of regulatory authority is granted by Treasury, and there are some, I guess there's some ability to do some loan forgiveness under that program or under that section. So if you happen to fall under that, you similarly would not be eligible for the delay. Again, if you, as an employer, direct a CPEO or a third-party agent to defer the payment of the taxes under this section, the employer or the customer, in the case of an interaction or a relationship with a CPEO, is the party that's solely responsible for the payment of those taxes when they're ultimately due. It's not a liability, if you will, that gets assumed by this other party or the CPEO. Thank you for your attention, and we'll turn it back to Lynn now. Thanks.
All right, everybody, we're approaching the home stretch. So we've heard a lot of great things about those payroll taxes. I would say for those of you who are listening who are going to be applying for the PPP loans or the EIDL loans, please be careful, as there's some pretty fine print of who is allowed to do the payroll tax deferral and the payroll tax credit. In my opinion, if you're going after the PPP loan, you're most likely not going to be able to get into those two significant payroll deferment and payroll credit issues. The next topic we're going to roll into is individuals. The individual update, we're going to first focus on something called the excess business loss limitation adjustment. Again, this was a relatively new tax law that was put into play in the TTGA Act. Okay, so I'm just seeing a lot of chat, so I'm just going to say they couldn't hear me quite well, so I'm just going to repeat for 2 seconds. I just want to make sure it is clear. I know Rob emphasized it, but be very careful. If you are applying for the PPP loan under the CARES Act, you are not eligible for the payroll tax deferral. Okay, so we just want to make sure, and there are, in addition, if you receive loan forgiveness under the PPP loan, you are not able to take the payroll tax credit, and there are clawbacks in each of those provisions to say if you do, they will claw back and come after you if you try to double dip. So I just want the group to be aware of that. Now we're going to move into individuals. Again, we're going to look at the excess business loss limitation adjustment. It was relatively new under the TTGA Act. We've been dealing it with for 2018 and 2019, and you can read the specifics for the slide, but essentially, if I was an individual owner of multiple partnerships or S-corps or even a sole proprietorship, I was responsible for totaling up all my business income and all my business losses. And before this was implemented, if I had $1 million of losses and I had $1 million of income, I could offset that. Under the TTJA Act, they actually said, okay, out of all your business income related to your flow-throughs and your sole proprietorships, et cetera, and look at all your business expenses. If your business expenses exceed the business income, we're actually going to cap you. And we're only going to allow you up to a certain amount of loss. So for non-joint filers, that loss they would allow was $250,000. For married filing joint filers, the loss was $500,000. So what does that mean? That meant if I had losses flowing through to me of $2 million, I was limited, again, net $2 million of business losses flowing to me. I was limited in the ability to utilize them against other items of income I might have to $500,000. This was significant for a lot of taxpayers with flow-through entities who might have been having significant losses flow through, and essentially caused quite a shock last year for many of our individuals who maybe weren't heeding the guidance, and by the time they saw their tax bill when they were so used to not paying any tax, they indeed did. The CARES Act essentially releases that law for the 2018, 2019, and the 2020 taxable year, that essentially there is going to be no cap again. So in my previous example, when I said, oh, let's make it very clear. Let's say my total losses were $750,000. I was limited under the previous law to $500,000. Now they're saying, forget that. You can take the full $750,000. The fact that it relates to 2018, 2019, and 2020 is also significant. They also, I know a lot of us were wondering in the tax world about whether or not when we combined all our income and losses from our trade or businesses, whether we could use my husband or my wife's employee wages to be combined in determining whether I have an overall loss and how much of the loss I do indeed have. A lot of us took the position that wages of our spouses could be included when looking at that total aggregate business loss. And essentially they have come out and they have corrected that and said going forward, when this starts to kick in again in 2021, you cannot include the wages of a spouse or yourself for determining if you have an overall loss or overall income. Now I'm going to, I know you've all been patiently waiting for the individual piece. I'm going to turn it over to our own Eileen Semler to give us an update on what does it mean for individuals with this new tax law.
Okay, so the thing that's probably been publicized the most, that everyone's heard the most about on TV and in the papers, is the recovery rebate credit. So these are the checks that the IRS is going to be sending out or direct depositing, hopefully within the next few weeks. And the amounts are going to be $1,200 per qualifying individual, plus $500 for each qualifying child. So do you qualify? The question is, if most people do qualify, you qualify as long as you are a U.S. resident, you're not a dependent of another taxpayer, and you have a valid Social Security number. You also have to have adjusted gross income under certain thresholds. For single individuals, that threshold is $75,000. If your income is below $75,000, you'll get the whole $1,200. If your income is anywhere between $75,000 and $99,000, there's a phase out. It's $5 for every $100 you are in excess of the threshold. For married filing jointly individuals, it's $150,000, and it's phased out between $150,000 and $198,000 in the same manner. But for a couple married filing jointly, you would be looking at $2,400, $1,200 per each individual. Now, the $500 per qualifying child, who's a qualifying child? That is your son, your daughter, your stepchild, an adopted child, a foster child, sibling, step-sibling, or a descendant of any of them, as long as they're under 17. And they lived with you and were supported by you. So these are basically the same individuals that you claimed as a dependent on your individual income tax return, but they do have to be under 17 in order to add that $500 to your rebate. How are they going to measure this? Well, they're going to look at your 2019 income tax return if you filed it. If you haven't filed 19, they're going to look at 18. And there is some planning that can be done here where If your 2019 return has substantially lower income than 18, you might want to make sure you get that filed and get it filed quickly. We really don't know what that cutoff date is. We don't know when they're going to decide to look and see, okay, these are the 19 returns, here's what we're going to do with them. So the sooner the better. If your 18 income is lower than 19, then you're probably going to want to hold off on your 19 return and not file that for a couple of weeks until they've gotten through their process. What if you don't file a return at all? What if you generally don't file? You don't have that much income, you're on Social Security. Initially, the IRS said that they were going to just have a form you could go online and fill out so that they knew how much to give to you, or they were going to look at other documents they had. They're saying now that they are planning to have a filing, that these people are going to actually have to file a tax return, a simple tax return. We don't know if that's a new form they're going to come out with, or if they really are going to have you just file the 1040 or 1040A. So we'll see. We'll hear more about that, I'm sure, in the short term. The rebates are supposed to be electronically deposited to your bank account that you've authorized the IRS to use. That means if you filed your 19 return and you said you wanted your refund direct deposited or you were going to pay through direct debit, they have a bank account to use and they're going to use that account. If you haven't filed for 19, they're going to use the account you authorized on your 18 return. If you have not authorized an account for direct debit, what we've heard most recently is that there will be a form online for you to go ahead and fill out to direct the IRS to direct deposit your rebate. Again, that is to come. It's a new law, and they're going to have to come up with that, and keep looking at the website, listening to us, and we'll let you know when we know more. Now, this actually is a credit, and it's a credit to be taken on your 2020 tax return, but they're giving you an advance payment of it. It's similar to what they did back in 2008 when they wanted to stimulate the economy and get a lot of cash out there. So when you file your 2020 tax return, the credit is going to be recalculated. If they decide that they owe you more than you were initially paid, you will receive that credit on your 2020 return. If they decide, or the calculation decides, that you were actually due less, you will not have to pay that back. So there's no downside with letting them use whichever year has lower income, because you're not going to have to pay back any excess that you received. The next thing that we really saw a lot of changes with is IRAs and retirement plans. IRS and actually Congress really wants to get cash flowing in the economy, and they understand that the markets have dropped significantly, and a lot of people are very nervous about taking their required minimum distributions because they don't want to sell stock to take cash out when the market's down. So the CARES Act has given us a suspension for the calendar year of 2020 where required minimum distributions do not have to be taken. Anyone who hasn't taken them, they don't have to take them for 2020 at all. They can wait till 2021, even if this was the first year that you had to take a required minimum distribution. If you have taken something already, you're really kind of stuck with that. You've got to pay the tax. But if it is within the last 60 days, you do always have that option of rolling money back in within 60 days of the time you take it out. Other than that, you really can't change that decision that's already been made. The next thing that Congress did was they said, okay, some people really are going to need some cash, so we are going to waive the 10% penalty for coronavirus-related distributions up to $100,000 that come out of IRAs and qualified plans. First, let's see what a coronavirus-related distribution is. That's a distribution made to any individual who's been diagnosed with COVID-19, whose spouse or dependent is diagnosed with COVID-19, but also anyone who has experienced adverse financial consequences as a result of either being quarantined, furloughed, laid off, your office hours reduced, you can't work because you can't get child care. Any of those things, any of those reasons or excuses allow you to take these distributions with no 10% penalty. Now, the other thing that Congress decided was, okay, if these people needed this money and needed to take it out, paying tax on it is going to be an additional burden. So in order to make that burden a little bit less, they decided to allow you to pay the tax on those distributions over a 3-year period. Now, that taxation ratably over the 3-year period is the law. You can elect out of that and decide, no, I want to pay all the tax now. Now, why would you want to do that? Well, if you're one of these people that Lynn was talking about, where you have a business with flow-through losses coming into you, and you have losses that can offset that IRA distribution or qualified plan distribution, then you might want to decide to pay all the tax this year because you're not going to pay any tax because you have losses that are going to offset it. If you're not in that situation and you're really going to get hit with a big tax bill, then you're going to allow that 3-year period and pay 1/3 of it in each of the 3 years, 2021, and 2022. The other option that you have is those distributions can actually be repaid to the qualified plan or to your IRA at any point over the 3-year period from when you receive the payment. So even at the end of that 3-year period, if you can put the money back, you'll be able to do that. Now, if you pay tax on some of it along the way and something happens and you're now able to pay to put it back, you still can do that, but you're going to have to probably amend those returns where you paid the taxes that you now no longer owe. Another consideration around this as well is if you are one of those people that has flow-through losses and 2020 is going to be just a really bad year, and you have money in an IRA but you don't need the cash, you can do a Roth conversion. And if you do a Roth conversion and you have flow-through losses to offset that income, you might be able to do it with no tax or very little tax. So that's just something to consider, something to talk to your professional about, and decisions that need to be made now. One other thing related to IRAs that I did want to mention is if you're looking at 2019 and you think, oh, I'm not going to get that payment or I'm not going to get that whole payment, is there any way that I can reduce my adjusted gross income for 2019 now? Well, there are 1 or 2 ways that you can do that. If you can make a deductible IRA contribution, you actually have until July 15th to get that done because of the extended due date of the tax return. Your IRA contribution for 2019 is due on the due date of your tax return. So you have until July 15th to do that, and you can look at what 19 looks like and say, well, gee, if I do that, maybe I'll get this stimulus payment or I'll get a bigger payment than I otherwise would have. You can also do that with HSA contributions because those are deductible and can be made up to the due date of your return. Again, these rules are limited to $10,000 of rollovers. And the last thing related to IRAs that they've given us is that you can take a loan from your qualified plan for up to $100,000 or 100% of your vested balance. The old rules were you could always borrow money from qualified plans that allowed borrowing, but it was limited to $50,000 or 50% of your vested balance. The new rule for 2020 is $100,000 or 100% of your vested balance. Okay, and the last thing we're going to talk about is, and one of the nice things when at least in the United States, when something like this happens, people become very, very generous. And people are making charitable contributions, and we are now able to get a greater benefit from those charitable contributions from a tax perspective. You know that a lot of people who used to itemize deductions really didn't last year because the standard deduction was so much higher. So in order to give those people a little bit of a benefit for their charitable contributions, the CARES Act has given us a $300 above-the-line deduction for charitable contributions that meet the rules for people who do not itemize. For people who do itemize, the rules were that for cash contributions to a qualified charity, you were limited to 60% of your adjusted gross income as far as how much you could deduct. For 2020, you can make and deduct those contributions up to 100% of your adjusted gross income. Now, both of these changes exclude, just like they did with your business contributions, they exclude contributions to private foundations, supporting organizations, and donor-advised funds. A lot of people set up donor-advised funds last year in order to get a bigger charitable deduction so that they could itemize. if you make your contribution to a donor-advised fund, you are still subject to the same limitations you were subject to under the old rules. The contributions have to be made in cash to a qualified charity, not a private foundation, not a donor-advised fund. And I think that is everything that we've wanted to talk about. Thank you very much for your attention. Again, we are going to look at the chat. We're going to look at all the questions that you've asked, and we're going to get answers to the most frequently asked questions out to you as soon as we possibly can. And thank you for your time.
I think we just want to follow up on a few administrative items. We thank you for your patience. We know that we're hearing that because of the number engaged in today, we might have had some people getting delayed into the chat, into the webinar. So we did want to let you know that everyone who signed up for the webinar will be receiving a video link that will be distributed so that you can follow this. I also would point out to you, we really want you to be our clients out there. We miss being with you, but we know we've been interacting with you. Please reach out to your client service engagement team to answer these questions. We have been ramping up throughout the week and making sure we're dispersing the information internally and externally. In addition, if we aren't your provider but you need help, we are doing our best to reply to your emails. We do take this as our responsibility to help our community and our area at this time. We've placed the emails up there so that you can reach out to us if we can help you during this time. As always, on a personal note, if you've heard me before, you'll hear me again. Thank you to all the essential employees out there throughout New York State and the United States who are helping us to still function. We cannot thank you enough for everything that you're doing. It's just eternal gratitude, and we appreciate all that you do. Again, we're very fortunate at the Bonadio Group to create a culture where we have placed many of our internal groups on tackling all these changes and making sure we're disseminating the information accurately and in a responsive time. I can't thank Rob and Eileen enough for all they have done regarding this CARES Act and the tax provision update. It was a huge undertaking, and we were lucky to have them with us. With all that being said, have a safe rest of your week. I would like to say this might be the last time we'll be doing this, but we have heard there's another bill going through potentially on the floor that Nancy Pelosi is working on. So instead of goodbye, most likely we're saying see you soon. Have a great day. Be safe. Stay sanitized, and we'll talk to you soon.